Hey, Craig from Wealth Minus Wall Street. I wanted to talk about today the question of will you do better? Will you make more money working with a financial advisor? And a lot of things that we do in Wealth Minus Wall Street, we let the numbers tell the story. So let's take a deep dive and look at the answer to this question. So before we get started, you have to know that you're paying a financial advisor for investment management. So sometimes when I ask people this question, they're like, well, they help me plan for retirement and they make sure I'm not going to run out of money, or they help me do this, they help me do that. That's all. That's all something they do. But the fact is, you're paying for investment management. And in our opinion, if you're paying for investment management, you should be getting something for that investment management. Otherwise, you shouldn't be paying for it at all. So once you establish this fact and this understanding, now we can take a look at what you're paying, which we talked about in a prior video, and then we can look at how can we accurately assess, is it worth it or not. So this is what we're going to talk about today in this quick video. Investment strategy. Okay, financial advisors, just so you understand, they follow a diversified age-based asset allocation approach, right? You probably heard advisors say diversification and you can't time the market, and you need an asset allocation strategy. That's what they do. Again, it's very important to establish that, because that's going to help you evaluate what you're getting for that investment management fee. So real quick, I always like to throw in some some quotes by some investment heavyweights, and Warren Buffett's a favorite of ours because he completely agrees with what we think here at Wealth Minus Wall Street. This was an answer to a question at one of his Berkshire Hathaway meetings, and this is talking about asset allocation. It's all merchandising. You don't need these people at all in investing. All these professionals who say you're going to be in big trouble if you don't listen to them are selling, right? And we completely agree with that. Again, my background, I was a former financial advisor. So everything I'm explaining to you, I lived it. So in essence, I'm pulling back the curtain and showing you exactly how the system is rigged against you. So this is taken from Vanguard, and this is just proof of what financial advisors do and how we make investment decisions, which in your mind, you think it's in your best interest, but it's not. Our goals are not aligned. The goal of the financial advisor is to keep you as a paying client for decades. You think the advisor's goal is to make you as much money as possible, and that's not the case. So what we're taught is the psychology behind like herd mentality, right? So we just want you to get market-like returns. If you get market-like returns, you're not going to question it because you're going to talk to your friends and family. Hey, how did you do? And I'm up X or I'm down Y. Perfect example is 0809. Okay, if you were down 30%, you might have been angry, but you talked to all your friends and you saw the headlines and how the market was crashing. You're like, well, I'm down 30, so it is what it is, right? Everybody's down 30. That's the psychology that Wall Street financial advisors tap into, which makes no sense, by the way. But what we're taught is get the benchmark. As soon as the advisor deviates from the benchmark in your performance, meaning your performance takes a diversion against what the herd does, what your friends and family do, what you're reading, in the headlines, that's when you start to ask questions. If it keeps happening, that's when you start to pull money. If it keeps happening, that's when you fire your advisor. This is from this report. It basically explains exactly what I just talked about. For advisors in a fee-based practice, substantial deviations from a core approach to portfolio construction can have major implications and result in an asymmetric payoff. Because investors commonly report that they hold the majority of their investable assets with a primary advisor, the advisor has less to gain from outperformance than lose if the portfolio underperforms instead. Although the advisor might gain slightly more assets from success, he or she might lose some or even all of the client's assets in the event of a failure. So when considering deviations from the market, make sure your clients and practice are prepared for all the possible implications. There's the smoking gun. They're basically saying, just get market-like returns, or else you could get fired. You don't want to do that. You're running a business. Good for them, not good for you. So then there's this whole question of, okay, so I have an advisor, I'm going to do better. Well, here's just another piece of data that says you won't. This is this graph shows various investor returns from the average equity fund investor from a company called Dalbar. They study investor returns. They've been doing this for a long, long time, and their findings are always consistent. The average investor, whether they work with an advisor or not, they almost always underperform their index, their benchmark. So just focus on the 20-year number. This was through the end of 2021. The average equity investor made 2.88% a year over 20 years for pretty much most of the 2000s. And by the way, this isn't including any financial advisor fee. This is just the actual investor. The 2.88%, that doesn't sound like a great deal to me. These, again, we like to use numbers at Wealth Minus Wall Street data. We use the adage, numbers never lie. This shows, this is from the S&P Dow Jones. This shows, again, a similar format of how many managers underperform their index, right, their benchmark. And I know this is a busy slide, but I just always like to focus on the S&P. So all large cap core funds, which is compared to the S&P 500, if you look at a 20-year track record, almost 97% of the funds underperform. If you look at the large cap core, 98 over 20 years, 98% of the funds underperform. And by the way, again, no advisor fee. So tack on an extra 1% here. You're not going to beat the market. You're going to do worse. Statistically speaking, you're going to do worse. Now, for a year or two, could you beat the market? Absolutely. But in our opinion, that's where the risk is. Because over the long term, it's nearly, as these numbers show, it's nearly impossible for managers to beat the market. So what are you paying for? This again is from Vanguard. This goes back to my earlier video that we just talked about, strictly fees. And this is, again, fees dictate your success. We find costs to be clearly the most significant indicator of future alpha, that means outperformance, with lower costs leading to higher returns on average. Morningstar, you've probably heard of Morningstar. They find the same thing. It's very common. You keep your costs lower. If you can keep your costs lower, you have a higher probability to do better. Financial advisors don't want you to know this information, though, because by definition, if you're adding a second fee, you're not going to keep your costs low. It doesn't work. So just a quick summary. Advisors aren't trying to beat the market. So again, if you're working with advisors, you think they're going to try to do better than the market and I'm going to get out performance, not the case. Some might, again, I would put it as maybe 1% of advisors out there might be doing that. So again, statistically, most likely not. You're paying them to beat the market. That's what you're paying for. If you're paying investment management, you're paying them to outperform, right? Higher fees increase the likelihood of lower returns. Most money managers can't beat the market. So again, if you just go down this and look logically point by point, the whole concept of paying what's called an asset under management fee makes zero sense, right? Great for the industry, horrible for you. So we encourage you to improve the odds of your long-term success. Again, nobody knows how the market's going to perform. Our job, though, is to stack the deck in your favor by putting as many variables as we can that remove risk and increase likelihood of better returns. So if you'd like a free strategy session, just a free phone call, learn more about what we do at Wealth Minus Wall Street, or in particular fees, investment strategies that Wall Street financial advisors use, we'd be happy to do so. My contact information is here, and we look forward to helping you. Have a great day.